Fed Chair Jerome Powell's testimony on Capitol Hill just began mere minutes ago. He is set to update lawmakers and investors on the possibility of interest rate cuts this year. As earnings begin to hold sway over market moves, how much of an impact will data and the Fed's expectations have going forward? Joining us now, we've got Dan Niles, who is the Satori Fund Founder and Senior Portfolio Manager. Dan, great to have you on here with us this morning. First and foremost, when you think about what the markets are clearly looking to more to really gauge where there should be more bullishness or where chips should be taken off the table, what most notably is sticking out to you about how there's more emphasis placed in different kind of fabrics of what we're seeing take place right now, earnings versus what the Fed is doing?
Well, I think you bring up a good point. If you look at the last 2 years, it was really all about the Fed. And what I mean by that is if you look at 2022, you had the fastest rate hikes in history. And the Magnificent Seven that year, on average, were down 46%. Then you move forward a year to 2023, and the Fed was on hold. People at one point thought there'd be up to 7 rate cuts coming this year, and the Magnificent Seven were up 111%. Again, even though estimates for some companies like Apple and Tesla actually went down all year last year. Now, this year, with those rate cut expectations falling from about 7 at their peak to now closer to 3, and we'll see if it even becomes 3. It may be less than that, just given how strong the labor markets are. Earnings are really starting to differentiate all these companies. And so the 4 of the Magnificent Seven that actually had numbers either hold in Microsoft's case or go up pretty substantially in the case of Amazon, Meta, and NVIDIA, those stocks are all up significantly. Meanwhile, the companies where the estimates have continued to go down, in the case of Apple, Tesla, and Google having some issues with their advertising business, those stocks are all down. And in the case of Tesla, almost down 30%. In the case of Apple, down about 12%. So I think earnings this year is going to be the big differentiator versus what the Fed does, because I don't see the Fed doing a whole lot this year.
So Dan, then are rate cuts then maybe not necessary in order for the market's momentum to remain here to the upside?
Well, I think to some degree, you're exactly right, Shauna, because if the economy is strong, at the end of the day, there's only 2 things that determine stock prices, right? It's earnings and the multiple you put on. And so if the earnings hold because the economy is strong, even if rates don't get cut by very much this year, I think the market can do okay. It's not going to be up 20% or something, but it can do okay because of that. But I think you're going to see a lot more bifurcation amongst the stocks in the market, where you're not going to be able to have your estimates go down and have the multiple expand because everybody's just bullish about rate cuts coming. So you're really going to have to start to put up the numbers. And that's the good news. This earnings season, you've seen the companies that actually do well with their earnings and outlooks, those stocks are going up. And the ones that aren't, those stocks are getting crushed. So it's a much healthier environment we're operating in versus one where every utterance by Jay Powell is really what's moving the entire market, and they're all moving together regardless of what individual fundamentals are.
Dan, is the Mag 7 as we knew it sunsetting?
Yeah, from the beginning of the year, I've called it the Fantastic Four. And so I've kicked out Apple. Earnings went down all last year. Didn't really matter for the stock, but because the multiple just kept expanding. Same thing with Tesla. The stock actually doubled last year, even though estimates for the December quarter came down about 50% over the course of the year. And then with Google, they're really at a moment where they have to figure out who they want to be, because right now they're under threat from the one hand in AI, where they're not really stepping up to the plate and providing accurate results with their AI search product, where other companies, whether it's Perplexity or ChatGPT, obviously the most famous, they're doing a really good job. So taking some share eventually in that. And then also in advertising, where in YouTube, you've got ad-supported tiers from the likes of Amazon or Netflix or Disney and streaming, taking away some of those ad dollars. And so they've also got an issue. So those 3 I kicked out. So I'm calling them the Fantastic Four because I'm a superhero fan.
Dan, what is the catalyst for the momentum in your Fantastic Four to continue here to the upside. There's lots of questions just about valuation. Obviously, NVIDIA putting some of those concerns to rest just a bit given the most recent results. But when you take a look at some of the other names, a name like Meta, some of the other ones that have outperformed Microsoft, but not to the degree of NVIDIA, what's the catalyst there?
Well, I think for each one, it's a little bit different. So I'm glad you brought up Microsoft. It's the one that I worry about the most because Copilot, which is their sort of AI offering that sits on top of their Windows offering, the uptake hasn't been that great. And you're paying 35 multiple for this company, and it's growing sort of in the mid-teens. And so I'm a growth at a reasonable price investor. If you look at NVIDIA for comparison, that stock is trading at a high 30s PE compared to Microsoft, but it's growing the top line at 90%. So from a growth to PE multiple standpoint, it's actually in better shape. If you look at, but Microsoft, obviously, they get more than 50%, they get close to 50% of the profits coming out of OpenAI, which produced ChatGPT. They're doing very well with their AI-related services. And so that's why we continue to like it. If you look at Amazon, it's really their Amazon Web Services, which hosts a lot of these AI applications, that's starting to accelerate again after having slowed down for the last couple of years. And so that's a positive for them. And their retail business has leverage. For Meta, they're using AI well for recommending videos to you and monetizing their ads. And so that's how you can look at all, four of the magnificent, or the Fantastic Four, I should call them, and why they're each one doing differently. And don't forget, we have an election coming up, and that's going to be really great for ad revenues, which really helps Meta out quite a bit. Google, out of the ones I kicked out, is the one I would like to get positive on, because obviously they'll benefit from an election as well. And if they change some of the issues they're having with their AI product, where they say, look, we're going to provide accurate results and let the users deal with that versus trying to provide politically correct results, that would fix a lot of the issues because people want accurate answers to their questions. And so they can fix that anytime they want. I'm not sure they will, but we'll see. And so that's the most interesting of the ones that I kicked out.
Dan, you mentioned elections, so I got to bring this up. We're looking at a Trump versus Biden rematch here as we look ahead to November. From an investor standpoint, is one better than the other for the market?
I mean, I think it depends on the sector you're talking about. So obviously, if you're more in the green energy sector, having a President Trump's not going to be as good as having a President Biden. If you're in the oil and gas sector, a President Trump will be better. And so I think it's kind of a mix. Obviously, if you're more related to China, for Chinese-related stocks, probably Trump is worse. Obviously, he's talking about 60% tariffs. And so I think the good news is, again, we kind of know what we're going to get with Trump because we already had him once. We know what we're going to get with Biden because we have him now. And so I think investors can kind of work through that. In general, Republicans are viewed as more business friendly. I think in general, I would go with that would work better if we have a split government, because a split government, quite honestly, is always the best, because when they really try to start to interfere in business, my feeling is they screw it up. So I'd rather have a split government no matter what happens and who becomes president. And I think that'll be the best thing for the markets.
Dan, just lastly, while we have you here, we've been rounding up some of the perspectives here on generative AI as a theme and whether or not a bubble is formulating and what needs to happen to make sure that it doesn't burst. Do you foresee any bursting of this generative AI bubble, and who are the first companies to get impacted as a result of that?
Yeah, there's a lot of questions in there. So the first thing is, are we in a bubble right now? And the answer is no, in the sense that it's too short. So if you go back to the internet bubble, Netscape Navigator, which was the first web browser, came out in December of 1994. It took till March of 2000 for that bubble to really break. And obviously had pullbacks along the way over the course of the 5 years. Now, if you look at today, ChatGPT showed up in November of 2022. So we're only about a year and a quarter into this. So it's not been 5 years. The second thing is, from a valuation perspective, valuations aren't in bubble territory. So NVIDIA, as we talked about, it's trading at a high 30s PE, but it's growing revenues at 90%. If you go back to the bubble, back then, Cisco was the most valuable company in the world. NVIDIA is now number 3. Cisco back then was growing revenues closer to 59%, but their forward PE was 138 times at its peak. So that's why neither from a time perspective, it's only been a year and a quarter, or a valuation perspective, you can call this a bubble yet. Will we get there? Absolutely, 100% think so. And obviously the companies that went up the most are going to get hit the hardest, just like you saw during the internet bubble, right? Amazon went down 95% from peak to trough when that bubble broke. Obviously, it's done well since then. And so you got to believe the AI darlings of today, they're the ones that are going to get blasted. But it doesn't mean they can't double or triple from here. If you look at NASDAQ, for example, it was up 570% from the end of 1994 till its peak. The S&P was up 200%. Right now, you're sitting at about 30 and 50% for those two respectively. So you could go a lot further before you really end up in true bubble territory.
All right, Dan Niles, always great to have you on Yahoo Finance. We hope you come back soon. Satori Fund Founder and Senior Portfolio Manager. Thanks so much, Dan.
Thank you.